Here's a summary of Joby Aviation's second quarter 2026 earnings call, focusing on key financial metrics, management's outlook, risks, highlights, and lowlights. Introduction. Teresa Thuruthiel, Head of Investor Relations. We begin today with the Joby Aviation second quarter 2026 financial results. This call will include forward-looking statements based on current expectations, and we encourage you to review our SEC filings for a discussion of related risks and uncertainties. We will refer to both GAAP and non-GAAP financial measures. CEO's remarks. Jobin Bevert, Founder and Chief Executive Officer. This is an incredibly exciting time for Joby Aviation. After years of dedicated work, we are on the cusp of launching commercial service. We are proud to announce that next month, we will conduct our first eIPP flights in Texas, a White House-backed program that will significantly accelerate our path to commercialization. These flights, in partnership with the FAA and state and local bodies, will demonstrate our aircraft's ability to transform travel in major metropolitan areas, progressing from pilot-only to carrying non-paying and eventually paying passengers. We remain on track to carry our first passengers this year. Our acquisition of Blade has been a resounding success. Over the past year, Blade's business has grown quarter over quarter, with aircraft availability, not passenger demand, becoming our primary constraint. In Q2, Blade saw a more than 50% increase in seats sold year over year, its best Q2 on record. We also experienced significant growth in New York City airport travel, and a more than 40% year-on-year increase in Hampton's revenue. Notable events like the World Cup, US Open, and Monaco Grand Prix also drove strong ticket sales. Given Blade's exceptional performance, we are raising our full-year revenue guidance. This growth is amplified by our existing relationship with Uber and a new partnership with Visa, offering premium benefits to cardholders on Blade's signature airport service in New York. The customer experience is at the core of our vision. Blade's success, particularly the New York to Hamptons route where customers value time savings over cost, reinforces the immense potential of vertical lift. Our Joby aircraft, being quieter and more cost-effective, are ideally positioned to enhance these journeys. Our presence at the Farnborough Air Show showcased our Blade service, connecting central London to Farnborough Airport in just 18 minutes, selling out seats on multiple days. This success led to a multi-year agreement with Virgin Atlantic to launch service across the UK, focusing on London and Manchester. We've engaged with a wide range of global regulators who are equally enthusiastic about vertical lift and are closely monitoring Joby's progress. The positive ripple effects of the eIPP program are evident, and many markets are seeking to replicate our momentum. A significant development is our strategic partnership with Atoms, founded by Travis Kalanick. Together, we aim to create new mobility hubs that integrate eVTOL charging and landing with autonomous vehicle charging and depot services, optimizing economics and customer experience. Atoms' expertise in real estate development and financing, coupled with a recent $1.7 billion funding round, makes this a powerful collaboration. We will initially focus on Florida, New York, Texas, and California for these hubs. Infrastructure investment is accelerating globally, with states like Florida offering significant funding and airports like Orlando developing vertiports. Dubai is also nearing completion of its second vertiport, with meaningful progress seen in Japan, the UAE, Korea, and Australia. On the aircraft front, we now have 5 aircraft flying, including our first FAA-conforming aircraft, with 12 more in production, 2 of which are slated for delivery this year. Manufacturing is challenging, but we've significantly improved our processes, reducing our non-conformance rate in manufacturing by nearly 40% in the first 6 months of the year. Our joint venture with Toyota, a landmark development, lays the groundwork for high-volume commercial production, mitigating a key risk. A senior Toyota manufacturing leader will soon join our team to drive this collaboration, aiming for a capital-efficient path to scale with exceptional quality and consistency. The eIPP program is crucial for commercialization and the safe integration of our aircraft into the national airspace. Our partnership with ASI, who will provide the central software infrastructure for managing U.S. airspace traffic, is vital for this integration. ASI's work on airspace operating systems will enable us to scale access to our skies. In summary, we are building the infrastructure, the aircraft, the customer base, and our operational experience. We've also made significant progress on the final stage of type certification. All these elements converge to unlock the third dimension of mobility and make electric vertical flight an everyday reality, giving people their time back. CFO's remarks. Rodrigo Brumana, Chief Financial Officer. The revenue guidance increase is a significant part of today's announcement, largely driven by Blade's outstanding performance. The energy and execution we saw at Farnborough, across certification, manufacturing, and commercial readiness for the eIPP, are truly encouraging. As of the end of Q2, we held approximately $2.3 billion in cash equivalents, and short-term investments. Our Q2 use of cash was approximately $202 million, compared to $195 million in Q1, which included the Ohio facility purchase. Excluding the one-time investment, our first half 2026 cash usage was $365 million, within our guidance range. Total property and equipment investment in Q2 was approximately $29 million, down from $78 million last quarter, as the Ohio facility acquisition is behind us. Capital expenditures remain elevated as we build manufacturing capacity. Q2 revenue was $39 million, primarily from Blade's passenger business, an increase of $14 million from the prior quarter. Blade's performance exceeded expectations, driven by seasonality, favorable weather, and demand around major events, which directly contributes to our raised guidance. Total operating expenses for Q2 were $300 million, a $42 million increase from Q1. This was primarily due to $23 million in continued investment for certification, manufacturing, and commercial readiness, $11 million in revenue-related costs, and $8 million in other expenses. On a GAAP basis, our Q2 net loss was $245 million, compared to $110 million in the prior quarter. This increase was largely due to a $108 million non-cash unfavorable change in the fair value of warrants and earnout shares, and a $27 million increase in operating loss. Adjusted EBITDA, a non-GAAP metric, was a loss of $197 million in Q2, compared to a loss of $179 million in Q1. This reflects the revenue and expense dynamics we've discussed. Our spending mix is shifting towards preparations for commercial operations and aircraft production. In the first half, capital expenditures were $107 million, including significant investments in our Ohio and Hollister facilities. We expect capital spending to moderate in the second half, though it will remain elevated due to ongoing investments in manufacturing and commercial infrastructure. We are investing in the foundational elements for passenger service in the U.S., including Part 135 operations, maintenance, training, and service systems. The eIPP program is a parallel path to certification, allowing us to build and improve the commercial aspects of our business concurrently. Our joint venture with Toyota is crucial for scaling production and sharing investment, leveraging Toyota's extensive manufacturing expertise. We expect Toyota's $250 million direct investment in Joby to close later this year or early next. Regarding guidance for the second half of 2026, we expect to use $385 million to $415 million in cash, primarily for certification, manufacturing, eIPP, and commercialization. This step-up reflects deliberate investment in commercial readiness as we scale into operations. We are raising our full-year revenue guidance to a range of $115 million to $125 million, up from the previous $105 million to $115 million range. With $63 million already recognized in the first half and Blade typically peaking in the third quarter, we are confident in achieving this increased range. Q&A highlights: eIPP fleet utilization and revenue. The eIPP program presents a significant opportunity to monetize every aircraft coming off the production line. Markets like Texas, Florida, and New York, along with California, can absorb significant production for the foreseeable future. Dubai operations will add further capacity utilization. Hydrogen propulsion. Joby has been exploring hydrogen propulsion for over 6 years. Hydrogen offers 3 times the specific energy of jet fuel, with fuel cell systems providing twice the efficiency of small turbines. This can lead to game-changing aircraft designs and represents a major disruption in aviation. Blade margins and demand. Blade has been a home run acquisition, showing strong growth and high customer demand for vertical lift. Flight margins have improved, and Blade is currently a cash-contributing business. The high demand allows Blade to absorb operating costs, including fuel increases, without a direct negative impact on the bottom line. eIPP aircraft usage. Both existing fleet aircraft and new company-conforming production aircraft will be used in the eIPP flight tests. Production ramp and aircraft deliveries. Joby is ramping manufacturing aggressively. The company expects to deliver at least 2 aircraft in the second half of 2026, with the goal of exceeding this target. The non-conformance rate reduction is directly improving efficiency and output. Defense market. Joby has been actively developing hybrid VTOL capabilities for the defense sector for 2 years, demonstrating improved range and capability on flying aircraft. They believe this positions them strongly to capitalize on opportunities across the Department of Defense, including strike, ISR, and infill/exfil missions. eIPP and certification credits. Joby sees potential for the eIPP program to accelerate overall certification through flight testing and experience gained. Close coordination with the FAA and local municipalities is expected to yield dividends. Adams Partnership. The Adams Partnership is a co-investment vehicle where both parties contribute capital. Adams' existing financing relationships and credibility will be leveraged for site identification, procurement, and development, resulting in a smaller capital share for Joby. This partnership aims to define a new asset class of mobility hubs. Dubai operations. Partners in Dubai remain highly engaged, with vertiports progressing well. Joby views Dubai, the UAE, and the region as a remarkable and exciting opportunity for flying. Blade's strategic role. Blade is viewed as a demand generation platform. While focused on retaining existing customers, they are also evaluating expansion opportunities, particularly in the eIPP markets. The primary constraint remains aircraft availability, which Joby aims to address with its own eVTOL aircraft. ATC modernization and ASI partnership. Joby is partnering with ASI, who will provide central software for managing U.S. airspace. Joby will trial ASI's tools in existing airspace with both Blade and Joby eVTOL operations, acting as a crucial sandbox for demonstrating increased flight frequency and paving the way for fully autonomous operations. Key financial metrics. Q2 2026 revenue $39 million, primarily from Blade, cash equivalents, and short-term investments, approximately $2.3 billion. Q2 use of cash, approximately $202 million total operating expenses, $300 million GAAP net loss, $245 million. Includes $108 million non-cash unfavorable change in fair value of warrants and earnout shares. Adjusted EBITDA, loss $197 million. Management's forecasts. Full year 2026 revenue guidance raised. $115 million to $125 million. Previously $105 million to $115 million. Second half 2026 cash use. $385 million to $415 million, reflecting increased investment in commercial readiness, significant risk factors, certification. Obtaining FAA-type certification remains a complex and lengthy process. Manufacturing scale. Scaling production to meet demand is a significant challenge, as highlighted by the difficulty of manufacturing at scale. Regulatory approval. Obtaining approvals for commercial operations in various jurisdictions. Infrastructure development. The pace of vertiport and supporting infrastructure development. Competition. Evolving competitive landscape in the eVTOL and urban air mobility sector. Funding. Continued need for significant capital investment to fund operations, development, and manufacturing. Highlights. Successful Q2 performance of Blade, exceeding revenue expectations, and contributing to a raised full-year revenue guidance. Preparation for first eIPP flights in Texas next month, marking a critical step towards commercial service. Progress in manufacturing, including reduced non-conformance rates and advancements towards FAA-conforming aircraft. Formation of a joint venture with Toyota to prepare for high-volume commercial production. Strategic partnership with Atoms to develop integrated mobility hubs. Significant engagement and positive reception from global regulators. Advancement in the final stage of type certification. Lowlights. Continued significant operating losses and cash burn, although within expected ranges. The inherent complexity and challenges associated with scaling aircraft manufacturing. The non-cash volatility in net loss due to fair value revaluations, which can fluctuate significantly quarter to quarter. This concludes the summary of Joby Aviation's second quarter 2026 earnings call.